Today, I'm joined by Jay Wright, the founder of Ecommerce Equation, one of the largest communities and training centers for e-commerce founders. In this episode, we dig into why so many brands scale revenue but lose sight of margin, the frameworks Jay uses to analyze CAC payback, contribution margin, and LTV, and he shares why the biggest volume of scale is coming from brands embracing Meta's new AI-driven algorithm and learning how to feed creative into that system. Welcome to In the Money, an exploration of whether you can still make money in D2C and CPG. We talk to some of the most interesting $5 million to $50 million founders, operators, investors, and acquirers in the space to ultimately answer the question, is D2C and CPG still a good business? Hope you'll enjoy the show. Jay, last time we caught up, I was kind of shocked that you've built this incredible business on an amazing insight. So the median Shopify seller, which probably does, a few million in revenue or several million in revenue, maybe spends between 5 to 15K a month on a marketing agency, largely because they don't come from a growth or media buying background. You actually found this white space by charging a fraction of that, but teaching them to do it themselves. How did you come up with this incredible insight?
Yeah, so I'd like to say I, had a business plan that was well thought out, and it was like an amazing idea that just came to me in a stroke of genius. But I think like a lot of innovative ideas, it was sort of a evolution. So I had an agency between 2012 and 2017. And I think over that period, I really saw the sentiment in the market shifting against agencies. And it became harder and harder to kind of sell and stand out. And there was just a general anti-agency vibe creeping in. So that was one of the reasons I sold my agency. And I went on to do my own e-commerce businesses after that. But what I was doing when I had my own e-commerce businesses was I was helping other people. I was helping, some close friends and some businesses that I'd stayed close to in a casual consulting capacity. And some of the results that they had were really compelling. And they would tell their friends. And at a certain point, I just started charging for my consulting. So it was a very organic kind of process that sort of led me to this new way of servicing brands. So rather than a done for you model, it was really this done with you consultative approach and help people build that capability and capacity in-house. So it was sort of like a super organic process, fan. It wasn't like a lightning bolt inspiration in the middle of the night or anything like that.
A lot of founders, a lot of operators will think about meta or media buying or paid as just a black box.
Mm-hmm.
I don't even know what I don't know. How do you get them over that initial hump, which ultimately leads them down the road of, hey, you can do it yourself without help?
Yeah, well, I think there still is help. It's just the service model is different, if that makes sense. So a lot of founders are really savvy. Like they've figured out Shopify, they've figured out Klaviyo. Like there's all these interfaces that they learn through necessity. And I think when it comes to Meta, the three things that I hear that people are worried about is they don't know what to do. They're worried about burning cash, and they're worried about how much time it's going to take out of their week. And so, we essentially solve for all three of those things. We spend $500 million per year on Meta ads collectively. We're the largest Meta partner in Australia, top 20 worldwide. And so we're out there figuring out what to do. And we spoon feed that to founders so they don't need to run the tests. They don't need to be across all the changes. They sort of rely on us for the strategy piece. And, obviously we have tracking and attribution and a lot of playbooks that help with the time and making sure they don't burn cash. And we have coaches there as a resource to help them as a backstop and give them that confidence. So I think that it is a bit of a black box, but you don't need to start from zero yourself. You can actually just tap into, our experience and expertise and systems. And then the actual execution piece is pretty simple. It's just like setting up Shopify or setting up Klaviyo. There's an interface you need to get familiar with. But if you're following kind of a step-by-step process and you have confidence in the playbooks you're actually following, it's not as scary as people think. And at this point, we've helped 4,000 founders take that leap across every single niche and vertical, old, young, you name it, right? So it's demonstrably possible at this point. And what I've actually found, fan, is that like most people don't have an agency anymore. I think when I first started this, 80% of people had an agency and 20% of people were sort of doing it themselves. And I think that's inverse now. I would say probably 80% of people I'm talking to have either been too burnt by agencies that they're not using them, or they've just chosen to kind of not even use an agency from hearing bad things about those experiences. So, the majority of people, I think, are actually trying to tackle this now themselves anyway.
Now for, again, the median Shopify founder, let's say they're doing maybe 5 million in revenue, nascent, a couple of years in. What percentage of their working time should they be spending on quote unquote growth? Let's say out of a 40-hour work week, or if you're a founder, or a 60-hour work week, what percentage of their time should they be spending on growth?
I think there's two very valuable contributions a founder should be focused on. Like at the end of the day, we're all in the business of buying and selling units. And I think most founders I work with are creatively inclined. They're very confident. They love their product. They love servicing their customers and doing new product development and planning out collections. And so they very comfortably fulfill the first role, which is acquiring products to sell and bringing great products to market. But the other side is like they actually need to build a market and sell those products, right? And essentially they're the two big things that a founder can most add value with to their business with. And so I think what I see a lot of is that founders spend a lot of time doing the other stuff, customer support, fulfillment, operations, and they're kind of activities that can pretty quickly be delegated for $15 to $25 an hour. And so like in an ideal world, I think you'd be spending like half of your time on growth and half your time on product. If I was thinking about the most value a founder could add to their business, and everything else I'd sort of divest, if that makes sense. So, and obviously that's not just meta ads, it's across, planning promotions, it's, all channels that you need to kind of fulfill for your brand. But yeah, the more time in those two areas, the better, in my opinion.
Just raised a new $35 million round of funding to, make sales tax less awful for e-com store owners. Simply put, Numeral is the platform for sales tax. They handle it all for growing brands. Think registrations, ongoing filings, exemption certificates, and end-to-end compliance. There are 3 things in particular that I love about Numeral. To start, they'll collect all of your sales tax notices and mail, scan it, process it, and make sense of it for you. If you've run an e-com brand, you know how annoying mail is. Second, they pride themselves on white glove service. Customer support is rarely a differentiator, but with Numeral it is. And finally, it all rolls up to their guarantee. With Numeral, your sales tax is filed on time, or they'll pay any penalties and interest charges. That's why I love Numeral and why brands like 8 Sleep, Mike's Hot Honey, and Ridge trust Numeral for sales tax. Check them out at numeralhq.com. And so if a founder really can spend 20, 25, 30 hours a week on growth, so let's just click into that bucket a bit more. Like, what are the top 2 or 3 things that they should be spending their energy on within that growth bucket?
I think that most of the, we typically work with brands that are sort of 1 to 10 million in annual turnover, and they're, looking to scale into the multi-8 figures or 9 figures. And so I think if you're in that bucket, typically you'll have one channel that is leading your growth, right? And so often people will be majority meta. Like I still think that's where a lot of the performance is coming from for most brands. There's definitely exceptions where people are more TikTok heavy or Google heavy, but the majority I'd say like are pretty meta heavy. And so some time in the Meta account would definitely fit into that bucket. But increasingly, like running a Meta ad account is becoming super automated through Meta's AI innovations like Advantage Plus, and the kind of consolidation. Like it used to take 11 steps to set up a campaign. Now it's kind of been consolidated down to 2 to 4. So I'd say more time on creative. Creative is actually the differentiator for a lot of accounts and a lot of brands. And so I think if a founder was spending like a couple of hours a day on marketing, like a good chunk of that should be spent on content, like actually personifying the brand, bringing, the lifeblood of organic and paid social into the accounts, right? So I'd say like good chunk on creative, a bit on the actual like ad account and optimization. And I'd say like, a lot of people are focusing on like one channel to get a fair way through their scale journey.
Now, let's maybe go even, I know the listeners love the tactical stuff. What is level 12 creative? What's really great? Is it enough to be doing just kind of high variations? Is it, hey, we need to do much richer kind of long form storytelling? Maybe, what are some success stories that you're seeing?
Yeah, look, I think everyone talks about creative diversity and creative volume. And it's almost like that message is getting a little bit lost because it's so prolific. But just to give you some tactical examples, like Meta has completely changed the way that it runs its ad algorithm. They've stripped out all the Intel CPU chips. They've been replaced with NVIDIA H100 GPU chips and their own silicon. And they've got a whole new algorithm that lives on top of that hardware. So it's basically a brand new algorithm over the last couple of years. And the main input to this is creative. So Meta's actually looking at the creative that you give it, and it's looking at who is in the creative, the copy, the messaging, the the visuals, and it's using like pretty advanced algorithms like Andromeda to go and match that ad to the most likely user to convert from the ad. And so what I've seen a lot of is people are doing a lot of creative diversity, but they might have one avatar, it might be, the actual founder. I'll give you an example. We work with a brand called My Sensory Space, and they do like fidget toys and stim toys for mostly for kids. And they had one creator, right? It was like a 35-year-old female that was doing all of their content. And they heard this message from us last year, and they went and got their mum because their second biggest purchasing avatar was grandmothers buying for their grandkids. And so they got their mum and featured her in a lot of creative, and she was a grandmother, looked like a grandmother. They spoke about like grandchildren and all this kind of stuff. And the algorithm immediately went and tapped in to a whole new demographic. And you could see in the demographic breakdowns that it skewed towards 55 plus women. And that performance from that ad was massive, about 1.5 ROAS points better than the base case, because they were tapping into an audience that was a key avatar that had previously been ignored by the algorithm because the creative wasn't servicing it. So it's not just about diversity for diversity's sake. It's about like a smart matching to purchasing avatars and creative and having, diversity across your key avatars. So I think that's kind of level 12 right now is actually understanding how the algorithm works and giving it the main inputs that it needs to go find new people and get them to buy.
Speaking of success stories, last time we chatted and you posted this on your Instagram, you had a founder client who had a dream exit. And without going into specifics, maybe can you talk about their journey and some of the things that they did right to win?
Yeah. I mean, I think that you're probably the same fan. Like a lot of people want to have a big liquidity event. They want to have an exit. And
I don't want that, Jay, just to be clear.
And there was a window in 2021, right, where I think the capital markets were hungry for consumer brands. And I think it feels like sentiment's changed a little bit. Like I actually feel like it's come back into vogue a little bit. So we had one of our brands, 9-figure exit, a really good deal. It was like majority cash deal, majority upfront. It was like really favorable terms as well. But here's the crazy thing. Like this founder 2 years ago when they joined our program was only doing a couple $100,000 a month, right? So
Wow.
in 2 years, they've sort of 15x their revenue and their profit, and managed to build like a really valuable asset with like a huge enterprise value. And I think that the journey that he went on was pretty similar to most of our brands, which is initially didn't have a lot of clarity on what he needed to do to move the business forward. So he used our benchmarking and our modeling tools to actually identify the constraint. His first constraint was didn't have control of marketing. And so he bounced from agency to agency, took marketing on himself before resourcing it. And that got him like his first leg of scale. Then he rolled out other channels like SEO, Google Ads. He was actually like quite diversified. Started to reach an upper limit with TAN in Australia and New Zealand. And so went to the US. When he sold, 60% of his revenue was actually from the US, right? So within 2 years, he'd been able to scale massively into the US. And I think that made him really attractive as an asset from this, the Southern Hemisphere. And then obviously, as you scale to that kind of next level, there's a lot that goes into like cash flow, debt funding, infrastructure, team, mission, values, culture. And so really there's just like a process of identifying the next constraint and allowing the founders to kind of have a rigorous focus and clear playbooks to move through those constraints. So while the outcome was an outlier, I think that the actual process was very similar to what a lot of brands go through, right? So hoping we see some more of those, Fan. I think it's great for the market to have 9-figure exits happening for everyone else as well.
Yeah. And then this is a bit of a lead into the next question, which is how much of it was, you talked about upper limiting and unlocking TAM. How much of that business and the success story and finding SEO to work and finding Google to work and finding North America to work was that either the category itself had huge momentum or the TAM itself was huge? Because I bet that there are founders that are following the best practices and just either the funnel math doesn't work or it's not quite there from a market perspective.
Yeah, there's definitely true limitations on e-commerce businesses. And I think, like you said, unit economics, total addressable market size are real limits. I think that on the TAM discussion, a lot of people that I work with think they are hitting the upper limit of their audience for their product, particularly niche products. So for example, I had a brand that sells journals for gardeners, very niche. When they started working with us, they were doing $30,000 months. And Alana was the founder. She was sort of saying, I think I've maxed out this product, right? And what we did is we sort of like helped her internalize growth, understand the funnel, and she was able to scale to $300,000 months with that one product in that one market within 4 months. So I found her was sitting there thinking that she'd actually hit the limit. And I think she 10x'd it. And it was probably even beyond that in terms of the actual limitation of her product. So TAM is real, but I think a lot of people really overestimate where the ceiling is on that. And even then, like some of the biggest success stories we've had, founders have come up against like either unit economic bottlenecks or addressable market size bottlenecks, but using like new product development, international expansion strategies, you overcome them, right? They're the hardest challenges to overcome, but you don't need to stay locked in to one opportunity vehicle or one product. And it's understanding when you actually have a true limit and you need to go and invest in, new markets, new product development to actually further your actual potential, or when you should kind of double down on what you've already got,
AI. Everyone's talking about it and you're worried you're getting left behind. Meet RichPanel, an AI-first customer support platform that's built for one thing: making support faster, smarter, and cheaper for e-commerce brands. Something you can actually feel smarter about using. RichPanel combines a unified inbox across email, chat, and socials, a customizable self-service portal that customers actually use, and Sidekick AI, powered by GPT-4, which learns from your past tickets to suggest on-brand replies. Does it actually work? Well, with RichPanel's guarantee, you get guaranteed 30% cost savings when you switch from Zendesk or Gorgeous, 30% automation to reduce your ticket volume, and a no-risk guarantee that if RichPanel doesn't deliver those results in 60 days, you get a full refund. That's why top brands like Ridge Wallet, Jones Road Beauty, and Pella Cases are already using RichPanel to save hundreds of thousands in support costs. Time to start letting AI work for you. Head to richpanel.com and start your free trial today. Real savings, real automation, real AI that actually works. Again, to stick with the, and maybe you weren't as close to it, or maybe you can't say, but, the journaling for gardeners, which, as you said, is very niche, but at least it's very clear kind of, was it more, growing 10x in 4 months is incredible. Was it more kind of ad campaign setup? Was it more creative and messaging? Was it more kind of on-site funnel work or something else?
Two things. Clarity. So a lot of people are sitting on a really workable funnel, but they just don't have clarity into what they should do. So they're constantly trying to optimize when really the correct answer is to maximize. So people will often be sitting on like a pretty functional funnel, but they don't have the confidence because they don't have the clarity to actually maximize it. So they might be making like a really solid amount of profit, yet they will still try and optimize it further. So the analogy I give for that is people have a ATM machine on the wall, they put $100 into it and $200 spits back out. Most people, if they had that level of clarity, would get as many $100 notes as they could to put through that machine. But some people go, I need to tweak this a little bit so it's $202 it spits out, or $205. And so people are constantly stuck in this optimization mindset. But when you give them clarity on their performance and benchmarks, they get a lot of confidence to actually maximize. So this is one of those situations which we started tracking her profit daily and she could see how profitable it was. And then we gave her control. So the other piece is control over marketing. A lot of people just don't know how to maximize the system because they're constantly relying on third parties, team members, freelancers, agencies to maximize, and they don't have trust. They can't actually push the buttons and see the results. So when you have those two things working in unison, like clarity and confidence, and then control over the mechanism that'll lead to growth, people will naturally spend more. You don't have to encourage them to. They can literally see the cause and effect happening in real time. And that's when you get this like crazy scale from brands, right? Until they reach the next threshold, whatever that is, right? Often it's stock outs or, other problems that emerge. But that was the scenario: clarity and then control.
The control part makes a ton of sense. The clarity, is that more a tracking, a kind of lack of tracking that's not driving clarity? Or is it the tracking is clear and they're kind of clear on the, I put $100 in and get $200 out, but it's more of a working capital barrier?
I don't think it's, in most instances, it's not working capital. It's literally just like a lack of understanding of what is happening day to day, right? So, especially earlier stages businesses, they're usually not on accruals accounting. They're usually on like cash accounting, and they're usually looking at their like P&L once a month, and they're looking at revenue, and they have these huge buffers for things because they don't actually understand, what the break-even ROAS is or what their MER should be. And then there's also a bunch of scenarios that are very unique to e-commerce businesses, such as people can often be efficient in marketing, but inefficient in fixed costs and overhead. And they think that they actually need to get more efficient ads before they scale. But through economies of scale, like you and I know that if you were to just get more throughput through that system, you get more fixed cost coverage and amortize those costs over more revenue and orders. So you can actually like get more efficient as you scale. And so there's a bunch of scenarios like that where people sort of stay in this no man's land of, doesn't feel like I have enough to invest in more ads, but the reason you don't is because you're not making more sales, and it's like a chicken and egg scenario. So there's a bunch of situations like that where it makes it opaque as to what you need to do if you haven't walked through that door thousands of times before.
Is there ever a situation where a brand really it just is hitting a growth wall and it's better to accept it to the size that they are and focus on profitability rather than continuing to throw dollars at new marketing campaigns?
I think there's always a choice a founder needs to make, right? So I've worked with people that have scaled to, from $6,000 a month to $1 million a month. And then rather than, with a team of like 8 out of her downstairs of the house, right? Rather than every 6 months, we do like a process called the preloaded year where we sort of map out budgets and actually kind of create that first model of growth for the next 6 months ahead. And, I was doing this process with this founder, and she sort of said, I actually don't want to grow. I want to just like be more profitable and kind of work less. And that's totally valid, right? So I think you don't have to grow. I think that no matter what the bottleneck is, there's usually a solution, right? So I think that the Australian, usually those limits come in terms of like total addressable market size or or capital, right? So capital could be solved by trading well, getting debt. There's ways you can solve that. And addressable market size, you can like expand channels. You can go like bricks and mortar or wholesale. You can expand markets. You can expand your collection. And so I think that a growth mindset is always good because, there is always competition and there is always a window where you have, you've been in business long enough. You've probably seen periods where something that was working stops working for market forces, competition, bunch of different factors, right? So when there's a window there where you can make money, you can grow, I think you should probably capture it. But most of the founders I work with are bootstrapped, right? So they've got one eye on growth, one eye on profit. It's not just growth at all sakes, and we're not kind of running, the venture or the PE models of just scale and try to get like a revenue multiple. We've always got an eye on profit as well. So you can kind of have the best of both worlds.
Do you spend much time with founders helping them think through positioning? Like if you have a men's basic apparel business that's focused on, all men from age 25 to 64, and even let's say they have a little bit of scale because it's a huge TAM.
Yeah.
But they're stuck. Are you working with them much on positioning and saying, hey, you need to tighten up the messaging to have a reason to win in market?
Yeah. So over the last 12 months, even 24 months, we've really called some shots well, which I think was media buying is going to be less impactful and creative will be more impactful. So we've built out a whole suite of creative curriculum and creative coaches and coaching. And that does extend into brand and positioning. So, a couple of months ago, we ran like a brand boot camp, which does go into like niche and avatar work. I do think a lot of brands, say the example you gave, which is like men's basics. We had Ben Yellaham from True Classic come and talk to our community. And I think he does this really well. Like you can still have a broad TAM, but you actually have the opportunity using meta ads to niche down in creative. So they have creative for dad bods. They have creative for gym bros. It's the same product, but they've just positioned it differently in creative. They have creative that targets like wags, wives and girlfriends of men, and essentially they're using Meta's algorithm to interpret the ad and trust that it's going to find the best avatar for the niched down ad. So I think niching down is important, but I also think that you can do that in multiple ways. Like you can actually have multiple funnels to different avatars that lead to the same product. And the fact that True Classic has been one of the fastest growing D2C brands of all time with a plain t-shirt that is exactly as you described, I think speaks a lot to that ability to kind of niche down with creative and not necessarily the whole brand message, if that makes sense.
Outside of growth, are there any other common buckets where founders are seeking the most help?
Yeah, look, I think most people that we start working with come to us because we are really good at helping brands grow and scale with meta ads. And what they find when they start working with us is that inevitably, ads only fix ads problems. And some of the times they get in and we realize that you've actually got a conversion problem, or you might have a unit economic problem, or you might have a cash flow problem. And theoretically, they're right. Like if you had better ads, really good ads, it might actually mask those issues enough that you could scale. But we're in a competitive marketplace for ads. So it is probably often better to go and actually fix the bigger constraint. And so definitely growth marketing is what we're known for. And we're incredibly good at it with, as I mentioned, like $500 million in spend every year. But really, either once you've fixed the bottleneck of being able to get customers predictably and scalably and profitably with ads, it opens up a whole raft of other problems, right? And so we've got a program called Accelerate, which is like specifically for mid 7-figure brands that have kind of gone through that initial process of clarity over numbers, control over marketing, and it goes and actually fixes the next round of problems, which is finance. Like, how do you actually finance growth and stock? And often that's about like suppliers in terms of trade and debt funding, or all those options. It's about expanding infrastructure, because you can kind of hack a $5 million e-commerce business together with you and a couple of people, right? But to go from 5 to 50, you can't really hack that out. And I think the big difference is that you need to actually go and go from like a scrappy sort of startup vibe, and you actually need to build infrastructure. So it's team, building out your org chart, and that also comes with like understanding your mission, your vision, your values, and your culture, because that's hugely impactful as you scale. And then it's also the whole infrastructure build out. Like, how do you actually create efficiencies and economies of scale with the operations of the business? So I think as marketing is the big pain point to start with. Once you solve that, it leads to a bunch of other pain points. And we've worked with a lot of brands along the whole journey to solve those problems as they come up.
What I want to tell you about today is Parker credit cards. Look, there are multiple subreddits dedicated to credit cards points hacking, and I get it. But what do entrepreneurs really want in today's market? Help managing their payback windows when acquisition starts ramping. With Parker credit cards, you get up to 90-day repayments on ad spend to help you on your cash conversion, rather than having all that upfront ad spend before revenue starts coming in. Parker allows you to spend aggressively while still managing cash flow, including meta spend. So instead of hunting for best points or cashback programs, realize that the best ROI is to be able to increase your ad spend without hurting cash flow. Go and check them out. Parker credit cards at getparker.com. That's getparker.com. Parker is a financial technology company, not a bank. The Parker Commercial Credit MasterCard is issued by Patriot Bank and a member of the FDIC, pursuant to license by Credit Card International Incorporated. Ecommerce Equation started in Australia and is growing incredibly fast in the US. How are Australian and US e-commerce founders different?
Yeah, I do think there are some big differences. And the thing with Australia is we're a pretty small nation. And so most of our brands are already selling into the US. So while it seems like it's a big change, we've actually been in the US for 5 years with our Australian brands. Some of the differences that I'd say, Fan, are that I think Australia is a pretty hard place to do e-commerce compared to the US. So just to give you some examples, we have a flat 10% sales tax, right? GST. New Zealand, it's 15%. If you compare that to the US, it might average out at like 4 or 5%. Our shipping is slow and crazy expensive, right? We have 20 million people, and the size of the shipment zone is the same as the US, right? It's vast and expensive to ship. Not only that, the consumer, like the US consumer, 75% of the US economy is domestic consumption. In Australia, it's only 50%. So, and they're way more trained to buy online because of the proliferation of Amazon, right? It's 55% of online retail. It's only 15% here in Australia. So we're just less inclined to buy online, more inclined to go to a physical store and go to Westfields and buy. So you've got this scenario where Australian founders have had to survive in far harsher conditions. And so as a result, we've been like really maniacal about a lot of one percenters to eke out profit. And so when you go and translate that level of efficiency to a market where it's got 20 times the consumer, they spend 50% more, they're far more likely to buy online. It's like, it actually has translated incredibly well, because not to say that US brands aren't focused on efficiencies, but it's a marketplace, right? So obviously you kind of settle to where you can make a benchmark amount of profit. And when you come in from a place of having to do a lot more to get that profit into a market that's easier, it actually has gone really well. So we have a lot of one percenters that are creating a lot of impact for US brands, and those first US brands that have joined are starting to get some incredible results. So, a lot of differences, a lot of similarities culturally and the way we all do commerce. But yeah, not too different, but different in a few ways as well, fan.
Yeah. Is there one marketing truth you believe today that you didn't believe 5 years ago?
Whew. There's more than one, probably. I think 5 years ago, if you would have asked me about the growth journey of a brand, I would have been pretty pig-headed on staying, direct to consumer online, right? I think I would have been really talking down other channels. Over the last 5 years, I've grown with a lot of brands. So I've seen brands go from 1 to 150 million, and a lot of like multi-nine-figure brands, and a lot of brands getting to the mid-eight figures. And I think I have now really changed my tune. I actually think at a certain point, channel expansion, whether that's like really smart wholesaling, store rollouts, even marketplaces, can be very complementary. And I've had enough inside views of brands that have, say, gone into big grocery to now understand there's not a huge amount of cannibalization. I actually think they're quite different consumers. So a lot of it is quite incremental. And I guess I used to believe that it would cannibalize and, all the consumers were online, and just to focus on one thing and keep things simple. But I definitely do think at a certain point, diversification of channel and even offline channels, right? I think can add a lot to a brand and help you monetize the product to market fit and the brand that you've created in new and novel ways that can really help with growth. So I think that's probably one truth, which maybe people are surprised at because I'm such an online guy, but I do think that there's definitely merit in other channels outside of online. I've changed my tune a lot on that, I think.
Maybe other than the big exit that your client had, has there been kind of a single biggest win over the last 12 months?
Yeah, we get wins all the time. I think that it's human nature to kind of focus on the outliers, and they make great stories. But I think what I spent most of my time focusing on is the averages. Like I really feel like I've got custodianship over this group of people that look to us to support their growth. So say in the last 12 months, 266 brands have hit their first six-figure month under our training and coaching. 50 have hit their first $1 million month. So to me, they're the numbers that I really look at as like our actual impact targets and goals. And then we're also looking at like average performance. So I'm far more concerned with the shape of the bell curve and how much it skews to the right than the individual outliers. So to give you an example of that, 2023 Black Friday performance, we benchmark average week's revenue during Black Friday compared to business as usual. So in 2023, the average Ecommerce Equation member did 6.5 weeks of usual revenue over the Black Friday weekend. 2024, that pushed up to 8 weeks of revenue. So we were actually able to help like 4,000 brands on average get 20% more revenue out of their Black Friday. And so like to me, they're the wins that I'm like really obsessed about, because I know that the area under the bell curve that skews to the right is my impact on brands as a whole. And I'm more focused on sort of like the collective success of our communities than the outliers, although the outliers are always fun. Like that 9-figure exit was definitely a career highlight for me. But day to day, I'm thinking more about the collective performance.
Yeah, that's amazing. Is there a tactic, channel, piece of tech that's working especially well for your brands right now?
I think that the primary go-to-market channel is still meta ads, right? So I think a lot of people don't have the awareness of how fundamentally the algorithm has changed from the hardware that runs the algorithm to all of the updates that have happened. So we're seeing pretty big step changes in performance from people who are sort of native 2025 social media brands or transitioning to be a native 2025 social media brand, and how that translates into better organic and paid performance using Meta's new AI suite of tools, right? So I think the the answer is sort of like better versions of what has been working for a long time, and actually really leaning into the tech investments that these big platforms are making. As boring as that is, I know everyone wants sort of like the app or the widget, and there's definitely those things that are circling around. Like there's always a new app, like say for example, Alia pop-ups has just gone mental through our community. It's basically like AI powered pop-up. I'm not sure if you heard of it, but it's kind of taking conversion rates from like 5% to 15, even 20% opt-in, big up improvements in SMS opt-ins. So those things will always circle. We actually go to those apps when we see them spreading, and we negotiate preferential pricing. So all of our members get 30% off Alia, as well as hundreds of other apps, because we go and negotiate like group purchasing power. So there's always that like next it app, and they come in and out of vogue. So Alia is probably the one that's going through the business at the moment. But beyond that, I think like really the volume of scale is happening from people embracing Meta's new AI algorithm and understanding how to get creative into that system that works.
Jay, as we head towards a wrap, is there anything that you're seeking from listeners, brands, operators, collaborators?
Yeah, I mean, I'm always down for a chat. So if you love e-commerce, give me a follow. I'm probably most prolific on Instagram, Jay Wright Official. If you want to know about Ecommerce Equation, it's ecommerceequation.com. And yeah, drop me a line. Always open to jamming out on e-commerce. As you can tell, I'm pretty passionate and nerdy about it, fan, just like you. So anytime.
Awesome. Well, Jay, this has been great, and look forward to next time.
Thanks, mate. Appreciate you having me on.